Hi, I'm Siu Ling Hui with part 3 of a video series about the cash flow statement. This video shows you how to use the cash flow statement to get insights into the cash flow and financing requirements of your day-to-day business trading activities. This is about your operational cash flow. It's vital to have a very good understanding of the cash flow of your day-to-day business activities so that you can make sure that you always have enough money to keep your business afloat. Fast growth usually puts a big strain on operational cash flow. Many fast growth businesses fail because they didn't understand and manage their operational cash flow. Here's a cash flow statement set out on a spreadsheet. The top section of the cash flow statement shows you how much cash your day-to-day business activities generate or use up. Cash flow is made up of two ingredients: how much money is coming in or going out, and the timing of the ins and outs. The cash flow statement shows you these two ingredients separately. The first part shows you how much cash you would have received from your trading activities if everything you did in your business was on cash terms. The second part adds the time ingredient. It shows you the impact of delays in receiving income in cash and delaying payment of expenses in cash. Timing is what can potentially turn healthy profit numbers into negative operating cash flow. Let's look at how you identify the amount of cash profit that your business potentially would make from your trading activities if every transaction in your business is done on cash terms. It starts with the net profit number that's taken from the profit and loss statement. The calculation of net profit includes non-cash items like depreciation and amortization charges. These types of expenses are book entries. No money is going to change hands with depreciation or amortization expenses. Then items that relate to investment and financing activities are eliminated. Why do we do this? Because the aim here is to identify only the cash flow that relates to your day-to-day trading activities. You don't buy and sell your car or plant and equipment every day. That's not part of your core business. Interest income and expense are also eliminated to remove the effect of your financing decisions so that you get a number that reflects only your business's operating activities and your business management decisions. The next part of this section of the cash flow statement shows you the impact of timing of receipt of income and payment of expenses on your operational cash flow. It's called the working capital requirements of your business. It's represented by items like debtors, inventory, creditors, tax, and so on. These items have a huge impact on your cash flow. It's absolutely critical that you get a very good handle on the working capital requirements of your business. Business growth almost always means increased working capital funding requirements, especially if your business involves inventory. Understanding the cash impact of your business's working capital helps you plan your financing and manage your growth at a sustainable rate. Let's take a close look at this section of the cash flow statement. To keep things simple, let's assume January is the first month in business. Assume we start with nothing in the bank account. We have sales of $300 this month, but only $100 is paid in cash. $200 is on credit terms. These become our trade debtors. In the cash flow statement, the $200 shows up as an increase in debtors. This has a negative impact on our operational cash flow because it's money we've earned but haven't received. Now, let's say this is an incredibly profitable business with net profit margins of 50%. So we make $150 profit on sales of $300. Let's say the $150 in expenses was all cash. So there's no depreciation or trade creditors to consider in this example. What the cash flow statement shows you is that even though you made a profit of $150, the business had negative net cash flow of $50. Cash payments exceeded cash receipts by $50. We started business with nothing in the bank account. This negative cash flow from operations means that the bank account goes into the red by $50. In our strategic planning before the start of our business, we would have anticipated this cash need before it happened and planned how to cover it. Now we are in February. The business is growing really fast. We double our sales this month to $600. $200 is received in cash. $400 is on credit terms, so our trade debtors are now at $600, $200 from last month, and the additional $400 this month. But during the month, half of the debtors from January sales pay their accounts. So this month, we get $100 in cash that was owing from January's trading. That brings total debtors down to $500. So what does the cash flow statement show us about cash flow from operations for February? We still have a 50% profit margin, so February's net profit is $300. $300 went out in cash expenses, so there's no need to adjust for non-cash items. But debtors went up by $300. The $400 increase from February trading minus the $100 owed from January's trading that we collected this month. This net $300 increase in debtors uses or ties up operating cash flow in our business. As all the expenses were paid in cash, there's no timing benefits of delaying payments to, say, trade creditors. So out of sales of $600, which turned into net profit of $300 in February, we ended up with no cash coming in from trading activities this month. What all this means is that over the 2 months of trading, we made total sales of $900 and net profit of $450. But we still ended up out of pocket by $50 cash because we had to pay out expenses in cash and we haven't received cash from all of our sales. We need to have planned for this working capital funding requirement and arranged to cover this $50 cash shortfall before we even started business in January. What if it was wages we had to pay in January and the bank wouldn't let us overdraw our account? Missing payday isn't good for any business. The ability to generate strong cash flow from business operations, the heart of your business, is critical for any business to survive and thrive. Fast growth often chews up a lot of cash because of rapid growth in working capital. You've got to keep cash flow, the lifeblood of any business, pumping through until the business reaches the point where operating activities start to throw off positive cash flow. Failure to properly plan ahead to cover the negative cash flow from operations is the most common killer of fast growth businesses. So tell me, do you review what's going on with your operational cash flow every month? Are there any inefficiencies in your debtors collection or inventory management? Do you know how much funding is required for your business growth? How much cash flow breathing space do you have to deal with changes in business conditions? Master your cash flow, know your finances so that you can drive strong, sustainable business growth and thrive. Thank you for watching. If this has been useful, please like and subscribe to my channel.